CFDs, futures, spot trading, options, and so on. What are these? What's the difference between them? What should you trade? You know, most people jump into trading without even knowing which type of instruments they are trading, or at least what types of instruments are there. Because they may trade something that doesn't fit their style and preferences. This can negatively affect their trading performance, and this leads to losing money. By the end of this video, you'll know exactly which type of asset might suit you. Hi, my name is Matthew and this is Focus Charts. So what types of instruments are there? Like I mentioned in the beginning, there are multiple instruments that you can trade. We are going to focus on the most used in retail: spot, CFDs and futures. Spot trading. Spot trading is the simplest form of trading. You just buy an asset like stocks, crypto or commodities and you actually own it. For example, if I buy one Tesla share, I'll hold it until I sell it. The difference between my purchase price and selling price is my profit or loss. But spot trading isn't really suitable for active traders. It's much more for investors, because as a trader, you usually don't want to keep a position open for months or years. Spot is basically designed for long-term holding. There's also no leverage, you can only use your own capital. That means if you want impressive results, financially speaking, you'll need a lot of money. Imagine you're a really good investor, making 20% per year, which would actually put you among the best in the world. But if you have just $1,000 account, that's still just $200 a year. Another disadvantage is that you can't short the market, only go long. And that's one of the main reasons why spot trading is for investors, not traders. Because as a trader, you want to profit not only when the market goes up, but also when it goes down. Okay, this is spot trading. If you're just an investor, this is exactly for you. If you want to trade, you should choose a different instrument. CFDs. For traders, this is often a better option than spot, because CFDs allow you to profit in both directions of the market. If the price goes up, you can buy, go long, and if it goes down, you can sell, go short. I'll explain those terms in more detail later. CFDs stands for Contract for Difference. When you trade CFDs, you're not buying the actual asset like you do with spot. Instead, you're only speculating on the price movement of that asset. With CFDs, you can trade almost any type of markets: stocks, cryptocurrencies, forex, commodities, and so on. And you don't need the large amount of capital, because CFDs are traded with leverage. Thanks to leverage, even small price moves can generate profit, but the same small moves can easily wipe you out. And that's why you need to be very careful with leverage and strictly follow your risk management. Otherwise, your account can disappear very quickly. When you trade CFDs, there are also fees you need to pay to your broker, mainly the spread and the swap. Spread is the difference between the buying price and the selling price your broker offers. For example, Bitcoin might be trading at $20,000. The broker could sell it to you for $20,002 and buy it back from you for $19,998. That $4 gap is the spread. It means that the moment you open a trade, you're already in a small loss. The price needs to move in your favor just to cover the spread. Swap is a fee you pay if you hold a leverage position overnight. Think of it like interest for borrowing money from your broker. For example, if you open a CFD trade on gold with leverage and hold it for several days, the broker will charge you a small fee every night. These fees can add up and eat into your profit or make your loss even bigger. So in short, the spread is what you pay immediately when you open a trade, and the swap is what you pay if you keep that trade open overnight. Futures. Another common trading instrument is futures. They work quite similar to CFDs, but there are some key differences. Contracts. With futures, you're trading standardized contracts, which are basically agreements between two sides to buy or sell an asset at a specific price at a future date. When you buy a future contract, you're entering into an obligation with another trader. Let's say you buy one futures contract on oil at $70. That means someone else in the market sold you that contract at the same price. If the price of oil rises to $75 and you close your position, your profit is the difference, $5 per unit of oil in the contract. The person who sold you the contract takes the opposite side. Their loss is exactly your profit. And if the price drops to $65, you lose $5 per unit, because you bought higher and now you have to sell lower. So just like with CFDs, your profit or loss is the difference between your entry and exit price. But the key point is that with futures, you're trading standardized contracts on an exchange, not just making a deal with your broker. Fees. With futures, you don't pay overnight swaps like with CFDs. Instead, the main costs are the commission per contract and the very small spread in the order book. If you hold contracts longer, you also need to deal with expiration and rollovers. And with perpetual futures, especially in crypto, you'll sometimes pay or receive a funding rate depending on market conditions. But that's something I'll explain in a separate, more detailed video about futures. So to sum it up, on spot, you mainly pay commissions, no swaps, and the spreads are usually small. You're actually owning the asset, best for long-term investors, not good for traders. On CFDs, you pay the spread immediately, plus swaps if you hold overnight, which makes them more expensive for long-term positions. You don't own the actual asset and only trading with price movements. On futures, you don't pay swaps, only a small spread and a commission. But you do need to deal with contract expirations or funding rates in the case of perpetual futures. That's why futures are often cheaper for active traders compared to CFDs. Orders, long and short. You've probably noticed I mentioned these terms in the beginning of this video. If you're a complete beginner, there's a chance you don't know what they mean. Long. This means buying. If you believe the price will go up, you open a long position. And short means selling. If you believe the price will go down, you open a short position. Now, the next question is, how do you actually open these positions? To place a long or short trade, you need to send an order to the market. And there are two main ways to do that, a market order and a limit order. Market order means you're entering immediately at the current available price. It's the fastest way, but sometimes you don't get the exact price you expect, especially in volatile markets. Limit order allows you to set the exact price at which you want to buy or sell. The trade will only be executed if the market reaches the price. It gives you more control, but there's no guarantee the price will get there. Okay guys, now you know what kinds of instruments you can trade and the main differences between them. If you're already trading, let me know in the comments, are you more into futures or CFDs and why? And if you're just starting your trading journey, I hope this video helped you figure out which instrument might be the right fit for you. Don't forget to like this video and hit that subscribe button if you don't want to miss my upcoming content. Thanks you for watching and I'll see you in the next one, and stay focused on charts.